So over the past several years, I've played around with the stock market, and I started out many moons ago buying some stock options. And I learned that if you make the wrong choice when you buy stock options, you lose your money. I read a book a few years back called Be the Casino, Not the Gambler. And in that book, it talked about if you sell stock options and you do it right, there's really no risk in losing your capital, or at least not all of your capital. And if the company that you're operating or buying doesn't go out of business, you're pretty much secure and you're going to make money all the time with the way I do it. If a person is watching this and they're planning to get into the cash flow investing with the stock market, hopefully you've already been smart enough to start out with infinite banking, because the hard thing to wrap your head around with the infinite banking is you can take the same capital that you're going to use to invest with the stock market and you could reroute it through infinite banking, and then you could literally be compounding that money for the rest of your life. So I have a strict criteria when I trade companies. First off, I don't buy options, I sell them. And when you sell them and set your contracts right, you're pretty much guaranteed that you're going to make some money one way or another. So I pick companies that pay dividends. I like to do a minimum of a 4% annual dividend. Once in a while, with a real strong company, I might do a 3%, but 4% is where I like to be. And I like to only pick companies who have increased their dividends every year for the last 10 years. So these are companies that are on their way up, or they're at least operating in a profitable way. You don't increase your dividend payments every year without making a profit. And that's what dividends are. They're profits shared with the stockholders. So I pick companies that have increased their dividend every year for the past 10 years. We know they're going up. We know they're operating solidly. And so the first thing I do is I pick these companies and I look at what the stock price is today. And if I wanted to buy these companies and just start collecting the dividends, which is income that comes into your trading account, I could just buy the stock today. But what I do first is I sell a naked put. It's called a naked put. And I basically say, okay, let's just, for an example, the stock's trading at $50 today. I'll agree to buy it for 45 in 60 days. And so there's going to be a chart that shows you the stock options, and there's going to be a price to make that agreement. And so I'm going to make this agreement, and I'm going to get paid, and it could be $2, $3 per share. And so one contract is 100 shares of stock. So if I say, okay, I'm going to agree to take this stock that's trading at $50 today, and I'm going to agree to buy it for $45 in 60 days, then I'm going to get paid based on that 100 shares. And remember, like I said, $2 or $3 a share. So I'm going to get paid $300 per contract. Now, here's the thing. It's $50 a share, so I have to have enough to buy 100 shares. So I'm going to have at least $5,000 in my account to buy that one contract, or to sell that one contract, because I'm agreeing to buy those shares at $45. So I guess it's $4,500. So in 60 days, if the price of the stock goes below the $45 point, I've agreed to pay $45. I'm going to have $4,500, and at that point, I'm going to own the stock. Now, I always set my date, so if I do end up owning the stock, I'm going to collect the dividend a day or two later, and that's going to be a credit that goes into my account, and I'm going to get paid a dividend. So let's say the stock goes down to $43, and now I have to buy it for $45. So the negative of that is I paid $2 more than the stock was trading for today, right? But didn't I pay $5 less than it was trading for on the day that I planned on actually getting into it, so I could start collecting the dividends? Because we're investing here for income. We're not speculating on whether the market's going to go up or down. We just want to get paid those dividends. I always make sure that the option will pay me more than 2 or 3 dividend payments. So If the stock doesn't go down below that $45, and I collected say $3 for sell, $3 per share for selling it, I'll just keep my $300 and then sell another naked put. So I'm always going to be making more than the dividend if the stock doesn't go down enough and I never end up owning the stock. Once I own the stock because it went below my option price, then I start collecting a dividend within a day or two. I turn around and I sell what's called a covered call. Okay. So now let's say I had to buy this stock for $45, even though today it's trading at $43. Well, now I'll turn around and say, okay, I'm going to sell a covered call, and I'm going to agree to sell this stock in 2 months, and I'll sell it for $50. So now I've just guaranteed myself if the stock goes up above that $50, I promise to sell it. So it could go up to $100, and I'd lose out on a whole bunch of gains. But no matter what, I'm guaranteed to make $5, right? So I'm guaranteed to make $500 because there's 100 shares. When I sell the option, it's called a covered call. I'm going to get paid $2 or $3 up front again. And if the stock doesn't go above that $500 or that $50 mark, I'm just going to keep the money from the contract. I'm also going to continue to earn dividends. Most of the stock that I do this with pays quarterly dividends. Some pay annual, some pay semi-annual, some pay monthly, and there's even some stocks that pay weekly dividends. So I make money. If the stock doesn't go down far enough, I keep the money. If it goes down too far, I buy the stock. Then I make money on the dividend, and I make money when I sell the covered call. If the stock goes way up in price, I make money when the stock sells. I turn around and sell another naked put. And I've done this over and over and over again on the same stock, the same companies. And so you're going to find in this course that we've put a lot of videos that I've created over the years, and you'll see a lot of them are the same company that I've just traded over and over again. And all these are active trades that I made on E-Trade, and I just shared my screen and showed what was going on. You'll also find some videos where once in a while I'd randomly just show the profit and loss that was going on in my trading account. And I really don't think I've lost any money doing this. I've had some trades that lost once in a while, but I'll usually roll that stock into a new date. So you'll see some red in the profit and loss, but normally that comes back in a profit somewhere along the line or when I finally exit the company. So enjoy the course, and thank you.